Algonquin Power and Utilities Corporation is a renewable energy and utility company with over 16 billion worth of assets across North America and internationally. They have got operations in the US, in Canada, Chile, and Bermuda, and this company is essentially headquartered here in our home in Canada, and we will talk about their capital expenditure plans later in this video. This company operates two business segments, the Regulated Services Group and the Renewable Energy Group. This is the annual report of Algonquin for the year ended 2020. Looking at the capital expenditures of this company, this is just huge. They have got here 13 billion worth of total assets, where majority are in the US and in Canada. The market cap of this company is sitting at $9.8 billion in the New York Stock Exchange. And this is a higher now because we are in 2021 mid-year and this was reported in 2020 year ended. Now, when it comes to electricity distribution, they have got thousands of miles on capital assets here. When it comes to gas distribution line, they have got thousands of miles on capital assets as well. They have natural gas connections, electric consumer connections, water and wastewater connections, wind turbine, hydroelectric, solar panels, and they have got this, guys, are truly stable when it comes to capital assets, thereby making the operations of this company truly stable as well and sustainable. The financial highlights of the company here, remember that these are all in million of US dollars. The total revenue of the company from 2018 until 2020 has actually grown. Yes, this is a truly conservative growth. Now, let's look at the total assets and total long-term debt of the company from 2018 until 2020. In 2018, the total assets was sitting at 9.3. So this is in billion. So that's 9398.6 times 1 million is 9 billion. And the long-term debt is sitting at 3 billion. So quite obviously, the company has got 3 times more of its assets as compared to its liabilities. And this is higher when it comes to the year of 2019. They increased their assets and also the long-term liabilities was not of the same pace. The assets was sitting at 10 billion and the long-term liabilities were actually sitting at 3.9. They only increased that at so much, which is about 600 million, whereas the total assets increased by more than 600 million. Now, what's interesting is in the end of 2020, they are sitting with the total assets of 13 billion and the total liabilities of only about 4.5. This is to say that they have got, the company, Algonquin, have got enough total assets to cover their debt and thereby making the company liquid. This is the historical dividend payments of the company Algonquin from 2009 until 2020, and in the 2021, this is the first half, so that's essentially 2 quarters of 2021. And as you see here, from 2009, they were sitting at 0.24 cents a share, and they grew this dividend payouts to $0.61 a share. The company's payout ratio sits at 54.8%. I would say this is more on the higher end. Therefore, this means that the company keeps about half of its earnings to reinvest in the company. But what's exciting here is that the consecutive growth years of the company is more than 10 years. In the last 10 years, they had been growing at a rate of 10%. And this is pretty consistent even to 5 and 3 year growth rate. It is sitting at 10%. And this is a good consistency rate. This is the record of the earnings per share growth of the company Algonquin from 2010 until 2020 and even until the trailing 12 months, at least the first half of this year. As you see here, in 2010, they were sitting at minus territory, but then they grew that in 2013, wherein they grew double digits on percentage. And from 2013, they have been growing on double digits until 2019, where they just went through the roof with a growth growth of 187%, and in 2020 at almost 50% here. Now, this is a good consistency because the company has been growing on double digits, and when you look at the actual earnings per share here, they grew from 0.03 to 1.27 in 2020. Yes, this is a conservative growth, but there is sustainability and consistency on the growth of this company. The US population is expected to grow by 1.8 million per year until 2060, and according to predictions, the country will cross the 400 million threshold in 2051. And with the growth of population comes the growth of demands for water, gas, and electricity, thereby making the products and services of Algonquin ever a growing necessity. It is then safe to say that Algonquin's source of revenue is stable. The company has got aggressive plans for capital expenditures. They plan to spend $9.4 billion on capex from 2021 through the end of 2025, and for renewables in operation and under construction, that is worth 3 gigawatt. Now, out of the $9.4 billion planned in capital expenditures, the company has already spent over $1.9 billion in the first quarter of 2021. And that, I could say, is aggressive spending as well. But what's interesting with the spending of this company is that it is already stabilizing its footing when it comes to renewable energy. The world is essentially and certainly moving towards a more renewable sources of electricity and utilities, and Algonquin is stabilizing its footing in this front, thereby making its sources of assets and revenue even more stable in the future. Now, let us compare Algonquin against its competition, which are Fortis, Brookfield Infrastructure Partners, and Hydro One. This is the comparison between Fortis and Algonquin Power and Utilities. Looking at the gross revenue, Fortis essentially just blew it up the roof, wherein the gross revenue was sitting at 9.14 billion Canadian dollars, and Algonquin was only sitting at 1.85 billion US dollars or Canadian dollars. But what's interesting here is that when you look at the net income, Fortis kept 1.24 billion and Algonquin kept 1.14 billion, and that is a very close call, wherein their gross revenue was 7-8 times higher than Algonquin, but the net income of Algonquin is absolutely almost 1-to-1 ratio with Fortis. This therefore means that Fortis has got major expenses, thereby depleting the net income. And when you look at the price to earnings ratio, Fortis sits at 21.91 and Algonquin sits at 10.76, thereby suggesting that Algonquin is cheaper than Fortis. This is only Fortis, and there's another company that we need to compare with Algonquin, and that company is Brookfield. This is the comparison between Brookfield and Algonquin Power and Utilities. Looking again on the gross revenue of Algonquin sitting at 1.85 billion, Brookfield is sitting at 10.09 billion, but then the net income of Algonquin is 1.14 and Brookfield has got a net income of 521.92 million. It's quite interesting when this company, Brookfield, earns 10 times more or 9 to 10 times more than Algonquin, but the net income of Algonquin is so much more higher, twice as high as the Brookfield Infrastructure, and therefore there becomes a question on managing of expenses. And here, when you look at the price to earnings ratio, Brookfield sits at 40.40 and Algonquin sits at 10.76. Even looking at the earnings per share of these two companies, Brookfield sits at 1.77 earnings per share. Algonquin sits at 1.85 EPS. All these numbers are suggesting very strongly that Algonquin is much better of a buy for us. And the last one of our comparison is a company called Hydro One. Both Algonquin and Hydro One are large cap utility companies. And when you talk about the gross revenue, the Hydro One gross revenue sits at 7.3 and Algonquin sits at 1.85 billion. As you have noticed amongst this competition or comparisons, Algonquin essentially has got the least amount of gross revenue. But if you look at the net income, Hydro One kept only 945 million of its revenue, and Algonquin kept more than 1 billion of its revenue. Again, Algonquin kept a lot more than Hydro One, considering the fact that the gross revenue of Hydro One was 6 times higher than Algonquin. And when you look at the price to earnings ratio, Hydro One sits at almost 20 and Algonquin sits at 10.76. Even when we look at the earnings per share of these two companies, Hydro One sits at 1.58 and Algonquin sits at 1.85. Having all of these figures and numbers considered, it seems and there is a strong suggestion that Algonquin is a better value for our investment. If we compare the stock price of these companies, Fortis is currently trading at $57.73 a share. Brookfield Infrastructure is selling at $71.28 a share. And Hydro Unlimited is currently trading at $31.55 a share. Algonquin Power and Utilities currently trades at 19.86. So amongst its competition that we have compared against Algonquin, Algonquin is the least when it comes to the price on stock. And another important factor that I always consider whenever I evaluate a certain company is the moat of the company. Algonquin's products, services, and overall business model is not easy to imitate. Therefore, entry of competition is a low concern. At less than $20 a share, I truly believe that this company is undervalued. So let me know in the comments below if you believe in the same thought process that I have for this company. Thank you very much indeed for watching this video. I hope that you gained value in this video and in my channel as a whole. And if you did gain value in this video, please like, share, and subscribe. And I will certainly see you hopefully in my next video. Thank you very much.